You sit down with HR, look at your benefits package, and see a reassuring promise. Long-term disability will replace 60% of your salary. For a mid-level manager, that safety net holds. But if you are a highly compensated executive or specialist, relying on that math is dangerous. The insurance industry operates on a tiered structure that actively penalizes high earners. As your income rises, the maximum percentage a carrier is willing to insure steps down. First, standard group plans apply a hard monthly dollar cap. If the policy maxes out at $10,000 a month, the formula stops there, even if your actual base salary equates to 3 times that amount. Second, those group policies typically exclude variable compensation entirely. If a large portion of your take-home pay comes from performance bonuses, commissions, or partnership distributions, the insurance company simply ignores it. Finally, the tax trap. When your employer pays the premium for your group coverage, any disability benefit you eventually receive is fully taxable to you as ordinary income. This chart demonstrates the compound effect of those 3 reductions. We start with a high gross income, but watch what happens. You lose a massive chunk to standard caps, you lose another to excluded bonuses, and taxes take their cut. A high earner expecting a 60% replacement rate frequently takes home less than a third of what they actually spend. For an elite proceduralist like a board-certified surgeon, a third of their income doesn't even cover their fixed monthly liabilities. The traditional market completely fails to protect them. You cannot fix this by searching for a single, magical policy with higher limits. The solution requires a specific architectural approach known as layering. Standard, off-the-shelf disability policies are mathematically incapable of replacing a high net worth income on their own. This 3-tiered pyramid shows exactly how we construct a layered portfolio. The base level is your employer group coverage, handling the initial, heavily capped foundation. Above that sits a supplemental policy from a standard admitted carrier. These contracts are the gold standard for guarantees. They offer fixed premiums and cannot be canceled or modified by the insurer until age 65. But standard carriers have strict participation ceilings. They also rely on rigid underwriting algorithms that quickly reject complex medical histories or unusual financial structures. That is why we build the Apex tier. The Petersen International and Lloyd's of London surplus lines market is specifically engineered to sit on top of your standard policies. By placing this layer at the top, we bypass domestic caps entirely. Monthly benefits can reach $250,000 or more, built on a strict own occupation definition, paying out if you cannot perform your exact specialty. The risk for this upper tier is carried by syndicates at Lloyd's of London. This market has held coverholder status for decades, successfully underwriting the specialty risks that domestic insurers avoid. Accessing this ceiling requires accepting a different structure. These are defined term contracts. When the term expires, renewal is not automatic. You must undergo re-underwriting based on your health at that time. Furthermore, because this is surplus lines coverage, it operates outside standard state financial regulations. If the insurer fails, you do not have access to your local state guarantee fund. Instead, your policy is backed by the global Lloyd's Central Fund. This is an uncapped discretionary market-level backstop. It operates through a different legal pathway, but it provides the massive capacity required to pay out 7-figure claims. You lock in a standard carrier for your unshakable, guaranteed foundation, and you use the specialty market to construct the uncapped ceiling you need to finish the job. High limits are only one part of the equation. Standard underwriting systems automatically reject perfectly viable applicants who don't fit inside tight algorithmic boxes. The surplus lines alternative replaces the algorithm with human medical staff. They review your file individually to negotiate and design custom coverage for prior health conditions or hazardous weekend hobbies. Moving from an automatic decline to full protection comes with specific trade-offs. The underwriters may require a higher rated premium or attach an exclusion for your specific pre-existing condition. The standard market also struggles with unconventional earnings. Talent in film, television, and music have intermittent project work and ongoing royalties. Standard contracts misread these royalties as continuing income, masking the true financial loss of a career-ending injury. We see the exact same underwriting friction with professional athletes and performance-dependent earners. Their physical specialty requires custom underwriting that acknowledges their actual, highly concentrated earning windows. Beyond personal income, disability creates massive financial liabilities for a business owner that a personal policy will never cover. If a practice owner goes out on claim, the business still has to pay lease agreements, staff salaries, and equipment loans. A specialized business disability program directly funds these specific operational costs while the owner recovers. Protecting the enterprise requires highly specific structural setups. We have to correctly assign the loss payee and ownership rights to ensure the capital flows directly to the company or the bank, rather than bleeding into the owner's personal household. The specialty market provides bespoke problem-solving tools engineered for risks that break traditional insurance models. This flowchart illustrates the strict order of operations for building a plan. First, you evaluate your actual income at risk. Then, your broker shops the standard market for your base. Finally, you apply to the Petersen and Lloyd's market to cover the remaining gap. We apply this map directly to W-2 corporate executives and firm equity partners. These are the candidates with the most dramatic mathematical gap between their employer coverage and their actual lifestyle. It also maps perfectly to situational needs: a new dentist needing collateral for a startup loan, an expatriate working overseas, or a professional working past age 60 whom standard carriers have abandoned. But if you have a straightforward, modest W-2 salary and clean health, this path is not for you. You will find better value and stronger lifetime guarantees sticking exclusively with standard domestic carriers. For the high earner, executing this strategy requires precision. You cannot simply buy a portfolio like this off the shelf. The Petersen high limit layer only works efficiently if the standard foundation beneath it is optimized. At Diversified Insurance Brokers, we operate as fiduciary architects. We actively shop the entire admitted market to lock in your strongest possible guaranteed base first. Once that foundation is secure, we seamlessly layer the specialty market on top. We align the definitions of disability and perfectly time the elimination periods so that zero financial exposures remain. Protecting a highly successful career requires acknowledging its complexity. True income protection means engineering a customized, impenetrable portfolio designed exactly for the life you have built.